Hello everyone, today we are going to talk about another topic in technical analysis tutorial series for Forex traders. So let's see what topic we have for today. So today we are going to talk about market and market analysis. So what kind of analysis you can do before you take your trade or before you take your position in Forex trading, or how can you develop your strategies based on your market analysis. So let's see what it is. So market analysis, there are three types of market analysis in Forex trading: technical analysis, number two, fundamentals analysis, and three, sentimental analysis. So let's see one by one what are these. So technical analysis, it is the study of price movement for an instrument, and this analysis is done on charts provided in the broker-backed softwares or trading platforms, and this most common is candlestick chart analysis on this technical analysis. It also gives us historical pattern and information of the price movement. The traders can get useful insight while study the historical price patterns. And some traders only use technical analysis for their trading, and they believe that everything is hidden in the price charts to determine price patterns and take a trade. So in technical analysis, the price shows us the trends of price movement and how we can recognize a trend and make a trading move. It also shows us how to recognize a change in a trend and then make a move accordingly if the trend changes. In technical analysis, it is also useful, and it tells us that the markets are repetitive in nature, meaning that price movements and trends repeat themselves. So it's important to have a good hand on technical analysis. So if you have seen one pattern and it is repeatedly, you are seeing it for quite some time at a particular point in time, so it means that that price pattern is repetitive, and it means that the markets are repetitive in nature. So technical analysis also gives us the clue of the possible price movements in the future based on the current and past price movements. And remember, it also gives us the clue of possibility and not the prediction. So it gives us possibilities, the indications of possibilities, and not necessarily a prediction that the market will definitely go into that direction. So there's a difference between a possibility and prediction. And technical analysis is also very subjective and discretionary. What it means that the trader uses his best judgment sometimes, or speculation about the price pattern, where the price will go in the future. The price may not move as the trader initially thought. So the subjective or discretionary or speculative approach may not go right at all, and the price may go the other way as opposed to what the trader initially thought. So this is how it looks like on the price chart. This is where we do the technical analysis. So you see when the price is going upwards, so it gives us that the price is moving up, it's bullish, it's positive. And when it goes down, it shows us that the price is moving down and it's a bearish market. So you see if there's a red line over here, it means that this is where the price has gone maximum, and then it comes back over here and then over here. So this is some kind of level where the price moves down, and then from here the price actually moves down, and from here you see there are two levels where the price first touches and goes back and then comes back again. It touches it and then goes back again, and then it goes into the upward direction. So this is how you actually do your technical analysis. Okay, so what is fundamental analysis? Fundamental analysis is analyzing the social, economic, and political environment that may or may not affect currency prices. There are factors that affect supply and demand in Forex market, and these factors are a range of economic indicators and data from every country. The hard part is how to analyze these economic indicators to determine the supply and demand in Forex. So you need kind of another analytical skills to digest and break down these economic indicators to see how the markets are moving or how the markets will move. So you need another kind of skills to study these economic indicators as well. So from an economic standpoint, this is a case of supply and demand. And what it is, does it mean in forex market? It simply means supply and demand of exchange rate of the currency that you are actually considering at that time. So again, the fundamental analysis gives us a better idea to determine the economic outlook of a particular country. And for this, we'll look at different economic indicators such as employment or unemployment, industrial production, interest rate, consumer spending, etc. So these are all the economic indicators, and there are many others so that you look at them. So to be able to use fundamental analysis, it is also essential to understand how economic, financial, and political news will impact currency exchange rate. So all these factors come into play. So if these economic indicators are good and positive, then the country's economic outlook is good and its currency will perform good as compared to the other country's currency, and then vice versa. So investors then tend to buy that currency and willing to invest in that country if the economic indicators of that country are in a positive trend. So it means that that country's currency is getting stronger. So just simply, it's easy to understand, if the currency has a high value, it means that it's a good economy of a country. If the currency has a low value as compared to other currencies, it means that country has a bad economy. So we can take an example of US economy where the dollar is gaining strength and they are increasing higher interest rate. So it only means that the demand of US dollar increases and the value of US dollar increases. So when the value of the currency increases, such as US is the strongest currency, so investors and traders then buy US dollars because it's safe to buy US dollars as an investment tool. So it will give them a profit in the end. So number 3 is sentimental analysis. Sentiment analysis is the overall economic environment in the forex market, whether the market is bullish or bearish. Okay, it also tells us that how traders feel about a particular currency market or currency pair, and traders then decide on their trading strategy after what they assess about the market sentiments. So what is market sentiment? Let's get into more detail. This combined feeling that market participants have is what we call market sentiment. So if the market is like in an upward direction, so all the other market participants feel that the market is like bullish, it's an upward trend. So this is what is called market sentiment. It is also the dominating emotion or idea that the majority of the market feels about the current direction of the market, as I just discussed. And having a sentiments based approach can help you decide whether you should go with the flow or not. So it also helps to do the sentiment analysis because it also shapes up a trader's strategy in the end. So you can combine market sentiment analysis with the technical and a fundamental analysis to come up with better trade ideas, as I just discussed. So in stocks and options, traders can look at volume trades and as an indicator of sentiment. And if a stock price has been rising but volume is declining, it may signal that the market is overbought. So sentiment analysis has two parts. We can look at it from two different angles, risk on and risk off. So let's look at them. So what is risk off? So the term risk off is used to describe the risk sentiment where traders and investors in the financial market reduce their exposure to risk and focus on protecting their capital. So risk off generally means that where investors just don't want to invest, they just want to protect their investment because they feel that the environment or the sentiment, market sentiment, is not that good. So when market participants are pessimistic, they are not that hopeful about the outlook of the economy, that's a risk of environment. And what could be a risk off trigger? It means unexpected news comes out that is super negative or increases uncertainty about the future. So this is how these risk of environments can trigger. So if you are in a risk off environment, you will notice that safe haven assets such as Japanese yen and gold, you feel that you will see that it is also historically true that they begin to rise, and high risk assets such as stocks and commodities, they begin to fall. So what is a risk on? Risk on when market participants are optimistic about the outlook of the economy. They will build up the price of the riskier assets. That is called risk on. Risk on. When you hear that traders are in risk on mode, this generally means they are buying risky assets, usually with leverage. So risk on is an environment where the market has a very positive sentiment and investors are willing to buy risky assets. So what are risk of asset? What are typical risk of assets? Number one, stocks. Stocks to suffer across the board, when it's a risk of. A good indicator is to look at the US stock indices like S&P 500 and Dow Jones and see if they are all trading lower to confirm just how strong the risk of sentiment is. And risk of assets would include US treasuries and German bonds because both are seen as almost risk free. And then we have currencies. Among currencies, the US dollar, Japanese yen, and the Swiss franc tend to rally as traders unwind carry trades. And what are carry trades? Are trades in which Japanese yen is borrowed at a low interest rate and then used to buy higher yielding, riskier asset in other markets. And then we have gold. Prices of gold usually rise and the yield on government bonds drops. So these are mostly the risk of assets. So what is risk on? What are risk on assets? Stocks, number one, for stocks traders, stocks in industries that are more dependent on economic growth. And bonds, for bond traders, lower trade rated but higher yielding corporate and sovereign issues are considered risk on assets. And then we have currencies. For currency traders, commodity currencies such as Australian dollar, New Zealand dollar, and Canadian dollar are kind of risk on assets. And lastly, we have commodities. And for commodity traders, industrial metals like copper and energy products like oil. These are all risk on assets. So that's about it, guys. I hope you like the video. I will see you next time. For now, thanks for watching. Have a good day. Bye bye.